So hello everyone, welcome back to our weekly watch list at Trace Trades. Today's the week starting February 29th. So we're just going to be going through our watch list real quick, got some broad market thoughts, and then we're going to turn it over to the server for some Q&A. If you're watching this on YouTube, make sure you click the link in the description so you could come into the server and watch the stream live. It is open to absolutely everyone, completely for free. So to get started with our weekly watch list, first we got Apple again. Apple is extremely dependent on whether we bounce here or whether we keep on selling, and I'll touch on that when we talk about more broad market stuff. But just on terms of a technical level, this feels like a pretty strong support to dip buy. Maybe if you're even just going to go in with a quarter or half position, I would say this is a pretty strong support for you to buy in at. We also have decent deviation from our MAs here, pretty far off the 8. Even the 4 has a little bit of a gap to our close on Friday. So I'm thinking we see a little bit of a relief bounce here. And again, I'll talk more about that in the broad market section. I also have apps. This chart is sloppy, but just because it's sloppy doesn't mean that the idea of the price action isn't there. So what we're seeing is a sharp decline down to this sort of support we have here, and then some pops in between. So what I'm reading this as just some momentum being added in. A lot of these days have really high buying volume, so when we hit the support down here, we flew up in volume as well, and we pushed through this top trend line. So I'm thinking a little bit more consolidation, and then once we break over this sort of 82 20 to 50 area, that's when we'll really start to see some more volume come in and push us above this 88 mark and up to the 90s. Draftkings is a name that's just been getting a lot of news, a lot of positive news lately, as well as a lot of flow. What's really notable and interesting about this name is the February 23rd candle right here. What happened on this day is we actually filled a gap below and a gap above in the same day. So that's just really interesting to see. And what we're also seeing now is it held this little range that we have here, and it's starting to curl towards the upside. If we take a look at the weekly as well, it looks like we just knocked off the top, curling bit, and ready to blow off top here. DocU, this is a very structured setup. I like this a lot. Just coming in to dip by the support right here. And even if you don't like channels, it's a support off these little two lows over here. MAXR, I'm not overly familiar with this name. This name has been getting a lot of notable flow recently. We also had this nice little wedge pattern, and it looks a lot stronger than a lot of other names that are currently trading. We also have MU. I think semis probably have the strongest chance of making a sharp rebound here. All of them look very strong, and MU is one of my favorites. We're pushing all-time highs here, got a little bit of an inside day. We'll see how we open on Monday, see if we're pushing all-time highs or we get this little bit of a pullback. Honestly, I would like more of a pullback, maybe against this 20 here, and that would make me confident to take along to push against these all-time highs again. We also have PLTR. We added our PLTR equity around 24.18, I believe. Yes, 24.18. We're dropping a little bit below that, but I do think that this is a bottom that we have sort of attained here. We got support, we have trend support, and we have very large deviation from our moving averages. By the way, if you don't know what I'm talking about when I say deviation from the moving averages, in a trend, you have your moving averages lagging behind. So whether it's an uptrend or a downtrend, you can see an uptrend here. The MAs are reasonably far from the price. Now, what's important to note is when they get very far from the price, say way up here at this 33.50 level, our 8 EMA is way down here, you expect a pullback because eventually these MAs have to line up again with our stock price. So you either expect a pullback or you expect consolidation. Same thing here. Even though it's in a downtrend, we're reasonably, or unreasonably in my opinion, far from our 8 EMA here. So I think that we're either going to see a nice little relief bounce or some consolidation. I also got PayPal on the list. PayPal is just looks like a stronger dip buy. We have this previous support right here, gap support as well, and the 50 MA is not far behind. So this just looks like a dip buy that looks a lot better than some of the other dip buys available. Snap. So socials have been going absolutely off. I have Snap and Twitter on this week's list, and I would have pins, but I think just Snap and Twitter look a little bit better. Pins looks really strong for this week too, though, if you've been following along with that. Anyway, Snap, we got this nice little consolidation of consolidation break. You can call it a flag, you can call it whatever you want. Just some price consolidation and then a break up. Very, very high volume candle here. Selling candles have diminishing volume, and then our buying candle again pops back up. So I'm thinking we see a nice little push here again. Again, something that we're noticing is we're right in the middle of our MAs here. We're not overextended. We actually have some nice room to base off of here that I really, really like. Also got Twitter. This support right here, or former resistance now support, is actually from our weekly chart from way back in 2013 when Twitter first IPO'd. So it's definitely interesting to see how it's going to react at this level. Just from looking here, it looks like it tested it 1, 2, 3 times before breaking back up. So I'm thinking we have a nice little support base to build off of here. And last but not least, we have Z. Again, Z is in this sort of dip buy category of like stronger dip buys. We're coming back down on this support. We actually entered into the gap twice and we pulled back up both times, so that's strength to me. And I just like the little sort of bounce play that we have building here. So that's all for our individual names. To talk about broad market, let's bring up the SPY chart. I've been talking about this channel for the last like week and a half, 2 weeks, like ever since we started pulling back. Because everyone was freaking out every single day we had a red day. I'll just send the channel and be like, guys, I think we're like 4% from all-time highs. We actually check that real quick. All-time highs to Friday's close, 3.5%. That is not a large pullback. That is very, very in line with a complete bull market. Pullbacks up to like 10% are normal for a bull market. Maybe not 10, 7 is a little bit more accurate, but even if it went to 10, I still would not be like worried all doomsday. But even a pullback of 4%, I saw a lot of people sort of really, really struggling keeping their portfolios up, and that's why I sort of decided to add the little risk management part we have coming up towards the end. But anyway, SPY looks fine. We held our 50. We held our 50 multiple times. We're in this channel too. Futures is popping up. I'm expecting tomorrow to be a reasonably strong day. I would like to see a nice little green candle, sort of maybe an inside day in this channel here. That would be absolutely splendid. Looking at the Qs are down a lot more from their highs. Let's check those to Friday's close. Yes, this is more 7%. This is more of a meaningful pullback, which makes sense. Tech is more comprised of growth, and growth is what has been getting hit a lot. So with the Qs, again, I think we could expect more of a bounce this coming week. Hopefully see a lot more buying come in. And there's one more line I wanted to show you guys. I drew it on the futures chart right here. This nice little daily line that we have here, 1, 2, 3 touches, and now it looks like we're pulling away a bit. What I think it will be interesting to see, however, is if we hold this bottom line, we're eventually going to have to go up and test this upper line. So I feel like we could see this consolidate here for a reasonably long time, which is why we're not really too big on any March contracts. We're not really too big on any options contracts, actually, because of just the sheer amount of consolidation that's possible here, or breakdown even. Alright, so that's all of my thoughts on what we're seeing for individual names and broad market. As far as risk management goes, nothing too big, but I just wanted to talk about some points that might help you guys in the future. So one point is don't risk any more than 3 to 5% of your account per play. Now, I don't really like making rules like this because I'm a firm believer in you should be rewarded for identifying very, very strong setups. So if you see a setup that's very, very strong, I'm actually more of a proponent that you could go heavier into that setup because you are so confident. But as a general rule of thumb, keep it to 3 to 5% of your portfolio. Something to also note is how much of your portfolio is in riskier assets. Options are one of the most high risk assets out there. Now, we do like to trade a lot of options in our little community here, but in terms of like a long-term outlook in your asset allocation, I'll just break mine down for you right here. Of the assets I have invested in the stock market, 15% is allocated to options, 15% is allocated to shorter term equity, which I'll take along with the option plays that I alert, or they'll be entirely separate. And then 70% is my long term equity. So you could see like how much of my portfolio is weighted towards long term equities, because that's building wealth. Working with options, that's sort of just trying to flip them, gain some money. Same thing with short term equity, trying to use technical analysis to predict shorter term movements. Long-term equity is about investing in these companies that we know are going to go further, so that is why it's such a larger percentage of my allocation. Another thing to also note is you absolutely cannot have any FOMO or greed in a choppy market. I guarantee you will lose money over and over and over again. You need to play technical analysis, and you need to play extremely safe even when you are confident. We know we're in a choppy point right now. We know this because of how VIX is moving. We know this because of how SPY is moving. We know this because of how the Qs are moving. And with all this, we just want to make sure that we're taking trades that will keep us safe. That's number one priority here, is staying safe. I don't really care about missing a move right now. That's not really what I'm worried about. I'm not even worried about trying to identify places where a move might happen. I'm trying to look for opportunities, sure, as always, but even when I find something I really, really like, my size is very small right now. So, just to talk about further, like talking about hedging, during this pullback, I just wrote down some like estimates. I was about 30% in long positions, 60% in cash, and 10% in hedges. Again, I think all of this is a little hard to visualize, so it's a lot easier if you do it yourself in your portfolio and figure out exactly what's right for you. Now, to talk more about hedging, what can you use to hedge? My favorite, I like to hedge with volatility and then just SPY and QQQ puts. I keep it pretty simple, but excuse me, there's all sorts of things you could hedge with. Like I said, SPY, QQQ, IWM, those are your three main ETFs, and DIA, of course. You could just buy puts on those. UVXY and SQQQ are leveraged ETFs. UVXY is about VIX and SQQQ is about the Qs. You could use those as either equity or option hedges as well. Something that's important to note about these leveraged ETFs, though, is that they are depreciating assets, so you definitely want to keep that in mind as you're adding to your positions. As far as expirations go, if you are going to hedge with options, it really does depend on what's going on in the market. But just as a sort of way to sort of guide you guys, in this sort of market, my hedges were anywhere from 3 weeks to 2 months out. So again, we kept it really short term. Meanwhile, my like longer dated plays are again more than 2 months to 6 months out. Also, when deciding your strike price, I like to go closer in the money. Some people I've seen like to go farther out of the money, targeting a certain price target. That's more, again, up to you, your style. I go closer to the money because I like having less theta. Also, something to keep in mind when you're hedging is hedge where your exposure is. So as we just talked about, SPY is down a lot less than the Qs. SPY is down 3.5%. The Qs are down over 7%. If you have more of your holdings that are like growth, that are NASDAQ Qs, tech names, things like that, you want to hedge against tech. You want to hedge against the Qs. So if I'm like all in on something like Microsoft or Tesla, not Tesla's a bad example, on Microsoft, then I definitely want to be hedging against the Qs and SPY. Okay, I think that's everything that I wanted to talk about in terms of hedging. Most of my hedges, again, for this sort of pullback, they were in volatility and then just SPY and QQQ puts. I also have a TLT position and then some metal positions just to be less invested in stocks. But those aren't really direct hedges, so I thought I'd leave them out of this discussion. In any case, that ends our weekly live stream. Again, if you're watching on YouTube, make sure you click the link in the description to join the server and come watch us live for the Q&A part as well.